Hello, beautiful people and option investors. Welcome back to your regular guy who trades options and teaches you how to get stupid rich. I'm just here today to teach you guys and tell you about the different strategies that I use to make money trading options. I've only been doing this for 8 years, so hopefully you'll learn a little bit in this video, or actually probably a lot. And you already know your favorite option YouTuber was thinking, hey, maybe I should make a video explaining all of the different strategies that I use and just lay it out there like a buffet so you guys can learn. So specifically, I got 5 strategies that I've been using and abusing for a very long time to make money, and I'm gonna teach you all 5 today. That way you guys can pretty much just feast on some knowledge, and I gotta use my finance and data analytics degree for something, right? So before I jump in with the best strategies, all I ask is that you smash that like button as if you were closing a profitable trade. And if you do happen to want a community of option traders and to see my live trades so you can follow along and ask questions, then the only thing that I have is the Option Income Academy, and you can book a free call if you qualify by using the link in the description below. With that being said, Henry, let's get talking about options. The most simple strategy to understand is buying call options. It's what every single beginner does, but I'm gonna tell you guys how to make this strategy work for you rather than feeling like you just went to the casino, put your life savings on red, and well, you know what happens next. There is definitely a way to make buying call options work, and when you buy a call option, you're essentially gaining 100 shares of stock without having to put up the money for 100 shares. But of course, because you get so much benefit, there always has to be a catch, right? Well, the catch is that if the stock stands still or doesn't reach your strike price, you can lose the premium that you paid for the option. Luckily, the premium you pay is a very tiny fraction of what it would cost to buy 100 shares of the stock. It makes sense to be a buyer of a call option when you expect the underlying price to increase. Although you better make sure that there is a case for the stock to increase. There are many situations in the market that warrant the purchase of a call option. Take a look, for example, at a NEO stock back on May 13th. The stock closed at $31.22. I know it's easier said than done to pull the trigger and buy at the bottom, but think about this. First of all, the stock is over $10 more than it was at the low even after a sell-off. Also, if you want to make call options work long-term and make a lot of money for you, then the optimal time to buy them is when the stock is already beaten down. This is for 2 reasons. Not only does it mean that you get a big reward if the stock goes up, but you actually have lower risk. Since everyone is selling the stock and optimism is very low, the option premium is going to be very small. So if you think about it, rather than buying 100 shares of stock, you only risk a couple $100. If the stock continues to tank, a stockholder will get absolutely crushed, right? Because he has 100 shares, but you don't because you just have the option. Now, if the stock rises significantly, your call option will gain a lot of value, and you didn't have to fork up thousands of dollars to buy a lot of stock to experience the growth of what 100 shares would feel like. If you do want to see how call options work on a whiteboard, I have a perfect video for you, which will be the second link in my description. Let's move on to the second strategy. The second strategy is a covered call. The stock market is weird. Every time one guy sells, another one buys, and they both think that they're smart. Now, for anyone that is part of my Option Income Academy, they know that I favor selling options over buying options. The more smarter option traders sell options from my experience. Now, I'm not calling you dumb if you're buying options. Don't shoot the messenger. I'm just saying I literally have seen the research, and it points to selling being more profitable and consistent. I keep it 100% honest here. I'd be a bad teacher if I didn't tell you what's more favorable from my experience. I'd love to sell naked calls, but that opens you up for unlimited risk. So instead, the only way to sell call options is to have 100 shares. Now, before you click off the video and say, well, I need a large portfolio, Henry, I don't have all of that capital, stick with me because I'll cover a strategy next after covered calls that doesn't require a lot of capital, but you still need to know how covered calls work. The more you know in option trading, the better you will be because you'll have more tools at your disposal. Here is what selling a covered call looks like. In relation to stock, you have more cushion with selling a covered call, so it's safer. You collect premium up front when you sell a call, and it gives you income and margin of safety, and the only real downside is you cap off some of your gains, but in return, you receive income and margin of safety. Let me show you what a covered call looks like on my screen. All right, guys, so we're gonna be taking a look at my portfolio right here real quick, and I'm gonna be showing you covered calls, and then later in this video, I'm gonna have more examples for you. So the first thing that I wanna show you is covered calls, and I have a lot of these positions open. I continuously sell covered calls because it's one of the best strategies that I have. And what I wanna do is I'm gonna look at a stock, let's say Palantir stock, okay? So let's say that you have 100 shares of Palantir stock and it's $2,194. All you would really do is you would go to trade options and you would go to sell call. Now, let's say that your average price is currently $21.95. Well, selling calls, the only thing that you do is you cap your upside. And let me actually go from July 30th to, let's say, September 17. Okay, you cap your upside. You can't make any more money than the call option that you sell. However, let's say that you bought Palantir at $21.95 and you're happy to sell it at $25. That would be a $300 gain on your hands in a fairly short amount of time. I mean, that would be less than 3 weeks worth of time. And for that, you'll actually collect $69. All right, I was trying to be funny. It's not very funny, but $69 would go into your pocket right here. And basically, that's an over 2% return because 2% of $25 is about $50. And this is nearly 3% return in just 3 weeks. So basically, about 1% a week will go into your pocket in terms of premium when you sell a call option, and you don't need a whole lot of money. You can actually just put the stocks that you already have to work. So any stock that you have, if you have 100 shares, you just go ahead and sell a call option. And here's the thing that you want to do. You want to find a sweet spot where you would be happy to sell that call option at that price. Because if you have Palantir at $21.94 and you think it's going to be a $23, $24 stock, then obviously it doesn't make sense to sell the $22 call strike, right? It doesn't make any sense because you expect Palantir stock to be higher than 22. However, like I said, if you only expect it to be 23 or 24, then why not sell the 25? It's basically free money. And even if it goes to 25, oh wow, boo-hoo, you have to sell at 25, but you've made a lot of money in terms of premium, about 3% almost. And if Palantir goes down or if Palantir stays the same, as stockholder, you know, he might have fluctuated a little bit. You probably made money on the option premium, and you most oftentimes will make money even if the stock goes down just a little bit. So let's say that Palantir goes down 50 cents. A stockholder lost 50 cents, but you've collected 68 cents or $68. So you're actually going to be better off than the stockholder in almost every single scenario up until $25.68 because that is your break even. That's where you can't make any more money. But don't get me wrong, you can't lose any money after $25.68, which is why this is my second favorite strategy. This is literally one of the best strategies that I have because you can't really be a loser with covered calls unless you really get upset at yourself for selling a covered call that is too low in strike price. But that you will fix with experience and with time. The third and really fourth strategy that I have here is selling spreads, because I'm going to talk about credit put spreads and credit call spreads. And both of these two strategies require very little capital. You oftentimes are just using $500 or sometimes $1,000, but most of the time you just need $500 to make a very huge return, whether it's a week or a month-long credit spread. All right, so now I'm going to talk about spreads. And this is going to be very interesting because today, as I'm recording this video, Amazon is down about 7.29%. Let me refresh the screen real quick. It's about down 7% because of earnings. And honestly, earnings were not that bad. They missed revenue by $2 billion, but AWS sales were really good. And if you guys take a look right here, I'm going to be doing a put credit spread example for you, first of all, because as you guys can see here, Amazon is down a significant percent, but it is so close to the bottom of its Bollinger Band range. And I just can't imagine that Amazon would go any lower from here because it already has very strong support. And I already made a trade on this earlier today in my private group, but I'm probably going to make another trade right now for you guys because I want to show you guys real life examples. And oftentimes I don't execute trades on YouTube, but I'm going to execute a trade in today's video because I really want you guys to learn as much as possible. If you guys notice here that there was a double bottom peak right here, okay? I'm very comfortable buying Amazon around these levels, okay? I don't think that we're gonna go that low. First of all, because the moving average is around 34.16. So that's good in terms of the moving average. And also the Bollinger Band range is right around 33.69. But even if I go back to this time right here when there was a lot of buying pressure and a lot of investors were getting in on heavy volume, I mean, even here, right, the bottom of the Bollinger Band range was still around that 3,200 mark. If you see right here, even at worst, if there was not buying pressure and instead we had a big sell-off, we would probably not sell off below 3,250. So I'm going to be doing a put credit spread and explaining to you guys how a put credit spread would work on Amazon and how much money you can basically make. So I'm going to do this live trade right now. Amazon is around 33.58, okay? And I want to trade about 3,200. I want to aim for the 3,200 level for Amazon put credit spreads. And a put credit spread, guys, is a very simple strategy actually. It's not as hard as you may think. It requires very little capital. What you do is you sell a put option and then you buy a put option. When you sell a put option, you collect premium, and when you buy one, you spend premium, right? But what you collect when you sell the put option here is more than what you pay for the put option down here, okay? I'm gonna show you exactly what that looks like. We're gonna scroll down to about 3,200, and as you guys will see, I actually have a position open, but it's not for July 30th, it is for July 6th. That is what's going on. So right here, you guys can see that I sold at 3,160, and then I bought the 3,150 for a total spread of $1,000. Now, what I'm going to do is I'm going to open up another position. I'm actually going to open up the same position because I'm pretty confident here, okay? So check it out, guys. I looked at the 3,160 because it's below 3,200. I'm very confident that Amazon will not go as low as 3,160. If I click into this option, the delta is 0.07, okay? Very low delta. In fact, it was 0.09 earlier today, just a couple hours ago when I was actually making the trade for my private group. But now it is 0.7, so it's even lower, but that also means that we're gonna be collecting lower premium. It looks like we're gonna collect about $38 on a $1,000 spread. And this is what you do, okay? You open up the trade by doing sell put, and you click right here, okay? So we're selling the 3,160 for $508, okay? But now, because you need all that capital, what you do is you close off the trade and you no longer need a lot of capital. You just need the difference within the strike prices of $1,000 when you buy the next leg below. And as you guys will notice, the next leg below is cheaper than the leg above. So you open up the next leg below, okay? So this is me selling the 3,160 and buying the 3,150. I click continue, and I'm going to open up one more position here. This is significantly less profitable within the last hour or two. I didn't expect the premium to fall so much. But if you think about it, in just 1 week, you're still going to be collecting about $35. I'm going to put $35 for $1,000 worth of risk, which is a 3.5% return. So you're going to be making 3.5% in just 1 week, which is still an absolutely enormous return. Earlier today, when I actually made the first lot of trades, it was actually about 5% return. So that's okay. I'm still going to go for 3.5% return because I want to show you guys how this is going to work. And you want to go for a credit. A credit means you're collecting money. A debit means that you're paying, okay? There you go. I got filled for $36, and the total collateral was just $1,000. So you made 3.6% if you execute on this trade at this very moment. And in 1 week, that's a phenomenal return. Now that you guys understand the third best strategy that I have, which is selling put credit spreads, I want to talk about call credit spreads. Call credit spreads are very similar to what I just did with Amazon. And in fact, maybe I will do it on Amazon again. Let me just open up the chart. So this is not going to be a good trade, I'll tell you guys right now, because the top of the Bollinger Band range is 38.84. And I already know for a fact that selling around 38.84 or 3800 is not going to have any premium at all. So instead, when you sell call credit spreads, what you want to do is you want to look for stocks that are pretty overvalued or stocks that are pretty high, because selling a call credit spread means that you don't expect the stock to rise past the strike that you're selling. So let me take a look at a stock that seems to be overextending and really rising up a lot. NEO is up 4.91%, which is phenomenal, but I'm a bull on NEO, so I'm going to expect it to continue to rise. That being said, maybe I can take a look at NVIDIA. We have been very, very successful on NVIDIA. I just want to make sure that I don't have like too many NVIDIA positions open at the moment. And perfect, we actually have an NVIDIA position expiring this week. So I'm actually going to open up an NVIDIA position for next week using a call credit spread, okay? Let's take a look at the chart real quick, because when we take a look at the chart, we're gonna get a sense of what is top of the range for NVIDIA and where you would want to sell a call credit spread at. I'm just going to be doing the same metrics that I usually do with charting, which is Bollinger Bands, RSI, and moving averages, okay? So NVIDIA is having a lot of sideways action here, and it's actually been a successful trade for me in the private group for 4 weeks in a row. And what I think is going to happen going forward is that we're going to continue trading sideways. We just had a split. A lot of investors were excited about that, but I was saying, I actually made a NVIDIA video on YouTube here a week ago saying how I don't think it's going to really rise because of the split, because we didn't see a huge rise when Tesla or Apple split. So I was right about that. Selling call credit spreads has been very profitable in terms of using that strategy on NVIDIA. So the RSI is about 53, so the stock is trading right where it should be. It is above the moving average, and as you guys can tell, one of the most important metrics is this Bollinger Band range up top here, 215. So what I'm going to do is I'm going to do trade NVIDIA options and see if I can sell a call credit spread for August 6th around that $215 level. And I don't know if it's gonna have a lot of premium. I may need to adjust this position to make it make sense, because I'll be honest with you, 215 is pretty high. But another thing that I can do is the Bollinger Band standard deviation was 3, so I'm just gonna change it to 2 real quick and make it a little bit more reasonable. So now $209, and that is a lot more reasonable to me. Around $209 is where I wanna sell a call credit spread. But unfortunately, it doesn't look like there's a whole lot of premium. Well, actually, it's not that bad, because if you guys notice here, I can do the 207.5 and the 210, and that's only a $250 trade. I mean, that's such a little amount of capital. The amount of capital that you need is just $250, and you can actually make a significant return right here. So I'm going to do the same thing with the put credit spread, but here with the call credit spread, we're going to be selling the call that is closer to the money. So that would be the 207.5. So you want to sell that because it's going to have more premium than the 210, as you guys can see. This one is worth about $53. And the 210 is worth $36. So now to complete this call credit spread and not have unlimited risk, because if you just sell calls naked, first of all, most brokers won't let you. And second of all, that opens you up for unlimited risk. So you're gonna buy call and you're gonna buy the 210 call. So now I'm gonna click here for the 36 premium. And as you guys can see, the difference is only $16, but you have to realize that you're only putting $250 at risk. So if you were to open 10 positions, then you would make $170 on just a couple grand worth of premium, on a couple grand worth of collateral. So this is a very good trade. I'm just going to open up one contract here for about $16 because I want to get filled here. But $16 as a function of like 250, I mean, 10% of 250 is 25. 5% would be 12.5. So this is over a 5% return. I already know this is going to be about 6 or 7% return in just 1 week's worth of time. So that's obviously a huge amount of premium. You can get absolutely rich if you can continue doing this. And this is oftentimes what I do, but I don't create big positions because this can be risky, right? If NVIDIA goes past $210, you will lose your entire collateral. And for that reason, I keep these trades small, and oftentimes they end up winning maybe 9, or even sometimes in a month, I'll only have winners. For NVIDIA, it was already 4 winners in a row, and this is going to be the 5th winner. But of course, you only need one big loss to wipe out all of your gains, so you wanna be very careful. That is the reason why I don't wanna go lower for something like 205 or even like, 203.75. I don't wanna go that close to the money because I don't wanna risk potentially losing any money. Therefore, I'm very happy collecting 6 or 7% return in just a week time frame and not putting out too much risk on the table, okay? So I'm gonna review this trade right here and I'm gonna submit it, and we're gonna collect $16 on 250. There we go. So we just collected a huge return, and this is actually the 5th trade that I have in a row on NVIDIA. The 5th and final strategy is selling iron condors. The beauty of this strategy is it takes so little capital to have a massive return. As you will see shortly in this video, I will do some trading. You will see exactly how I make 15, 20, and even 25% a month on iron condor trades, and they're actually not as risky as you may think. Now, my students and I are able to make these returns on a consistent basis, and one of the best strategies that I've used and seen is the iron condor. And the reason I love selling iron condors is because you take advantage of time value of options, and you also sell both calls and puts. Now, options naturally decay, and this decay is called theta. Theta is the money that goes into your pocket pretty much like a magnet when you sell options that are approaching their expiration, especially in the last couple of weeks, which is why I tell so many students to sell options in the last couple of weeks, is because they're decaying at a rapidly increasing pace. Especially when you sell iron condors, because as I will explain to you in just a minute, the full process from start to finish, iron condors sell both sides of calls and puts of a stock. Therefore, you collect double the premium. Iron condors are also perfect to discuss in this video as my 5th favorite strategy because they combine the concepts of spreads. So first, if you learn how to do spread trading, iron condors are naturally very easy to understand. An iron condor is essentially just selling 2 spreads for a total of 4 options. The iron condor puts probability, option time premium selling, and implied volatility on the trader's side because you're the one selling the Iron Condor. The Iron Condor strategy is one of the best ways for an option trader to profit from an insignificant move in the price of an underlying asset. Now, many traders believe that they need a significant move upwards or downwards needed for a profitable option position. However, that is not true with an Iron Condor. In fact, you're doing the complete opposite. You're hoping in your game strategy is that the stock stays within a certain range, and oftentimes that range can still be huge and you can profit within a huge range, and you would only lose if the Iron Condor went beyond the limits of your ranges. Iron Condors make money sideways and in volatile markets so long as the stock doesn't run up a huge amount, like let's say 20 or 25% in a single week, or down 20 or 25% in a single week. But even when that happens, your winners will far outweigh your losers because this option strategy is oftentimes winning 80 or more percent of the time. Now I'm going to show you how to open an Iron Condor and why Iron Condors are so amazing. I'm going to do this on Apple stock because I already know that Apple has very liquid options, and the option trading on Apple is very good because of volume, open interest, and so many other factors. So the first thing that I do, and you guys already know this from this video, is you're gonna sell a put credit spread, because to open up an Iron Condor, it's basically selling two spreads. You're selling put credit spreads and you're selling call credit spreads, which is exactly why earlier in the video I was teaching you about put credit spreads and call credit spreads, because when you combine the two, you get an Iron Condor. Here's what an Iron Condor looks on the screen right now. Cool, okay? So let's open up an Iron Condor. I'm probably not gonna execute on this trade, but I'm going to show you exactly how it looks like. You're going to sell, for example, an out of the money put option, let's say the 140 on Apple, and now you're going to buy the next leg down, okay? So that's going to be the 139. So here you have collected $7 on a $100 worth of risk. If you do the math there, that is 7% return. It's actually over 7% return in a single week, okay? But things actually get even better because when you sell a call now, a call credit spread, and we open up that Iron Condor, only one leg can happen, right? You can't have the stock be below 139 and above 150, for example. So Robinhood and every single broker out there knows that an Iron Condor, when you open up that second call credit spread, you don't actually end up using any more collateral. So you only need $100 for this trade, and this call credit spread that we're about to open is basically free money. We're about to collect more premium, and we don't have to put any more capital out there. So I just wanted to show you guys, if I scroll down here, you can see that it says $7 and max loss is just $93. Now this is only going to get better. So I'm going to sell a call, let's say for let's just say we don't think Apple's gonna rise, so we're gonna do the 149, okay? So we're gonna sell the 149, here I'm gonna scroll up so that doesn't confuse you. 149, and then I'm gonna go buy the 150, okay? This creates a call credit spread, which we just went over, and as you can see, now Robinhood knows that this is a short Iron Condor, and if I go look at the payoffs, now you have $21 worth of max profit, and your max loss has only gone down to $79. This is a very highly profitable trade, and as you guys can see here, the payoff chart, right, you're gonna be profitable as long as Apple stays between $139 roughly, and on the top of the range, you need Apple not to go beyond about $149.21. So as long as you stay within this range, which is a very high likelihood of Apple staying within that range in just the next week, you're going to keep the $21 for $79 worth of risk. And that's really interesting because you can also do, let's say, 10 contracts. So you can make $210 on $790 worth of collateral. So you're basically making almost 30% return here because 25 divided by 75 is about 1/3. So you do have to be careful. You don't want to open up huge positions in Iron Condors, but you do want to use Iron Condors to your advantage so you can make very high returns on a weekly basis. Also, people will always ask me, Henry, how can I become involved in option trading? If you do want to learn how to produce consistent weekly income and create cash flows safely without taking a lot of risk or waiting impatiently for a single stock to grow, then definitely check out the link in the description to the brand new Option Income Academy, where I go over my option calls, picks, and plays in real time, breaking down my full thought process. You will also get very hands-on access to me and my team of 6- and 7-figure coaches. Click the application link below to see if you qualify for some free training. And as always, guys, be aggressive in learning, but be safe investing. No one ever sees me.